people that you choose when you get the policy. These are the people that when you die get money. And you can pick one beneficiary or you can pick multiple beneficiaries, and you can divide up, like one person gets 50%, another person gets 20%, 10%, etc. That's up to you. You get to make those choices. The premium is the purchase price of the policy, which is based upon the age and health of the policyholder. The reason they base it on age and health is because of your likelihood to die. The less likely you are to die, the cheaper your policy is. The more likely you are to die, the more expensive your policy is. They make these decisions using something called a mortality table, which is a table listing the average death rates, male or female, by age. And men and women do have different insurance prices, because if a 20-year-old man and a 20-year-old woman both walk into the same insurance agency and get the same price, hers is going to be cheaper. Women live longer than men. That's just a biological fact. So the insurance policies are cheaper because they have a lower death rate per age. Then the face value is the value of the policy, and that's the amount to be paid upon death. And you can get life insurance policies for as little as $1,000, or you can get them for millions of dollars. Just depends on what you want to pay for. Most people end up getting term life insurance, which covers you for a specified length of time, which is the term. And then it either expires or has to be renewed at that point, at which point the rates will change. So the term life insurance, the monthly payment or the annual premium is locked for the length of the policy. So if you get a 20-year term life insurance, the price can't change during that 20 years, but as soon as that 20 years is over, if you start a new policy, it'll be a different price. It does not earn any value. Term life does not earn value. The only way there's going to be any money paid from that policy is if you actually die while you have it. A group life insurance is a term life provided by your employer, and you basically, as long as you still work there, you still have the insurance. And some, probably most, offer the option to carry it into retirement, but you might have to take over the payments on it. Depends on the company. So usually with group life insurance, you do pay something for the life insurance, and the employer pays part of it as well. Or you pay all of it, but because there's so many employees, the rates are much lower. So life insurance through your employer is usually less expensive. But again, it's also term life. So if you quit your job, you don't have it anymore. Level term insurance. You have level term, decreasing term, and increasing term. Level stays the same throughout the policy. Your face value stays the same and your payment stays the same throughout the whole length of the policy. Decreasing term life, as the policy goes, there's set times where it will decrease the face value. So you may buy a $100,000 policy, but by the end of the term it might be worth $20,000 or $50,000. But as that happens, the payments also get lower. And then you have increasing life, where as time passes, that $100,000 policy becomes a $200,000 or a $300,000 or a $500,000 policy, and your payments go up. Why would you want these? Decreasing term life. Let's say you have kids and you want to make sure they're provided for, and you get a 20-year term life policy, and maybe they're 10 already. Well, you don't need as much coverage 20 years from now as you do right now, so you could get a decreasing policy, and then as they move out and go off to college and you have to pay for it, your life insurance payments are lower, so you have a little bit more money. Or you might get an increasing term life insurance because maybe you can't afford as big of a policy as you would like to have right now, but you're starting a new job or something, and you know that you're going to get raises and you might be able to afford it later. And so as the term, the 20 years goes, the policy value will get higher and your payments will go up, but you're planning on being able to afford it at that time. The thing with insurance is if you have a policy and you renew it, is cheaper than like not having a policy at all and then going and getting one later. So that's why you might do an increasing so that you keep those lower rates when it's time to renew, but still have that higher coverage that you were looking for. Does that make sense? Any questions on those? Okay, so those are all term life. So they all end at a certain period, either a set number of years or like employment when you don't work there anymore. Then there's permanent life insurance. Permanent life insurance covers you for your whole lifetime or until a certain age. You can have a policy that ends when you turn, some certain age. These are whole life, universal life, or variable life. These policies are a lot more complicated than term life. Term life is usually pretty simple. I'm going to pay this much money per month, and if I die, my family's going to get X amount of dollars, period. With permanent life insurance, because it gains value, in most instances, it gains value. And so it's very complicated because there are conditions when you can and can't pay. With term life insurance, you don't pay, the policy's canceled. With whole life insurance, if you don't pay, things happen. It's a lot more complicated. So you want to read all of the details very carefully because these are investment life insurance policies. They're not just basic coverage. They're more expensive, but they offer better coverages because they are an investment and they gain cash value, whereas term life insurance has no cash value. Once it's over, it's over. That money that you paid for, it's gone. Okay. So we have those three types, which we're going to go over. But before I get there, whole life insurance has an investment feature. It's basically like a savings account with a higher interest rate. The premium, when you buy a whole life policy, at the beginning, when you're young, which is when you should buy a whole life policy, because if you don't buy them when you're young, they're really expensive. So when you're really young, you buy a whole life insurance policy. And at the beginning, throughout the policy, it's split. Part of it goes to the insurance portion, and part of it goes into the investment account. When you're young, it's a larger percent into the investment and a smaller percent into the insurance premium. But as you age, it becomes less into the investment and more into the insurance based on, as you age, your chance of dying increases. But these do have cash value, which means that investment portion, that part that's going into like that savings account, that's your money. Now this money will be less than the face value of the policy at any given time, most likely. But if you decide you want to cancel the policy, you get that money back. So let's say, you live to be 70 and you're retired and you can cash out your whole life policy and have all that money. That's why this is sort of seen as kind of a retirement investment, whereas term life would not be because it has no cash value. If you decide to change the value of the policy, though, let's say you go out today and you buy a $100 whole life or $100,000 whole life policy, and then 10 or 15 years from now you decide you want like a $500,000 whole life policy, they cancel the current policy and then you get a new policy. They have to rewrite it and write you a brand new policy. And that is different than universal life insurance. Universal life insurance is like a whole life insurance. The differences are if for some reason you can't pay your premiums, the insurance portion, they will take the money out of your cash value account to pay the premiums for you. Again, just the insurance portion, whatever that part is. So if for some reason you run into a bad spell and you can't pay your insurance, if you have enough cash value in the account, it'll pay for it for you. So your policy doesn't have to be canceled. Huh? It's both. It's good because you still have the coverage and you still have the policy and you keep that same rate at that point. It's bad because it dips into the cash value of the policy, so that investment feature gets deplenished the longer you don't pay. And then if that money runs out, then the policy's gone. So it's kind of more of an emergency situation thing that you could do. Both whole life and universal life allow you also to borrow against the policies. You can borrow money out of your own cash value and then pay it back with really, really low interest rates. So it's another way to take out maybe a low interest rate loan someday if you ever need to. So that's kind of nice. Then you have variable life insurance, which is, instead of being sort of like a savings account for the investment portion, it actually gets invested into stocks, bonds, and money markets. This is a high risk life insurance policy because the cash value fluctuates based on the stock market. So you could have paid in $10,000, but if the stocks do badly, it may only be worth, $3,000. So this is a really high risk insurance account. And if you have a variable life insurance account, you want to make sure that your financial manager knows what they're doing and will move it into safe or markets that are doing well. With it, Jack's 40. In 10 years, his house will be paid off and his daughter will have completed college. He wants to take out a 10-year level term life policy with a face value of $750,000. So if he should die in the next 10 years, then his daughter will get the $750,000. His monthly premium is $76. What is his total cost over the 10 years? So we've got 10 years, 12 months each year. So he's going to pay $9,120 over the period of 10 years. But again, if somehow he passes away before he's 50, the policy will pay $750,000. Questions? Logan, on the other hand, purchases a whole life policy with a face value of $100,000 when he was 28, and the annual premium was $123. He wanted to increase the face value to $250, so they had to do a new policy. His premium increased to $166, so we're going to calculate the percent increase. So new minus old divided by old. So we have 43 divided by 123. I should double check myself. So it was a 35% increase. He has a universal life insurance policy with a face value of $250,000. His cash value is currently $8,260, and the premium is $97 per month. Okay, with a universal life policy, if you're unable to pay the premium is paid for you. So out of your cash value. So he has $8,260 in there, a $97 a month premium. So if he's unable to pay the premium, he will be covered for 85 payments, which is 7 years. It's a little bit, it's almost 7.1 years, but we'll just say 7 years that he could go without paying a policy if he had to. So that's kind of the nice thing about the universal life, because if for some reason you can't make the payments, they just take it out of your cash value. You don't lose your policy, which keeps your premium. This is part of a mortality table. We have the exact age, your probability of death, which is a percentage. So we have a 2.7% chance of dying when you're 41 if you're a man. And your life expectancy, this is continued life. So you're expected to live for 36 more years. As you can see, as you get higher, your percent chance of death goes up and your life expectancy goes down. So when you're 50, your life expectancy is 28 more years. Your death probability? Yeah. Yes. So, Joe is an insurance agent, and Zach is a 45-year-old man, and he wants to know about a life insurance policy and how can Joe assess the risk when they offer him the policy. Well, what they do is they find the probability right here that he's going to die. So the first step is to find the probability. Which is 0.003732. Okay, and that means that there is a 0.37% chance of death. Right? So his rate will be based on that. Because well, it's not just based on the probability, it's also plus his health, plus his, where he lives, geographic location, and his history of tobacco, and the amount of the policy. But first they're going to learn, they're going to check the probability. The insurance company covers, we'll just say 7,000 45-year-old men. Okay, there's 7,000 45-year-old men that the insurance policy covers. How many die before 46?
Less than 1%.
Well, it's going to be less than 1%. So what you're going to do is you're going to take that 7,000 and you multiply it by the probability. First you turn your calculator on. Then you take the 7,000 and you multiply it by the probability. So what the insurance policy is doing is they're gambling that you will not be one of those 26 when they offer you a policy. Because if they offer you, let's say, a $200,000 policy that you buy when you're 45 and then you die before you turn 46, you've probably paid them like $600 and then they have to pay your family $200,000. This is not a good investment for them. So they're making a gamble. But it's still, again, low probability. But that's why the higher you get in age, the higher the policy premiums are. Questions on that? Sells a 5-year term life and policy with a face value of $150,000 to a 41-year-old man for an annual premium of $648. What is the profit the company receives from selling this policy for each age of death? Okay, so it's an annual premium of $648 annual, right? So if he dies at 41, and let's say he's already paid the policy, they have to pay out $150,000 but he's only paid them $648. So they have a profit. Well, they have a loss. So their profit of negative $149,352 is the loss. At 42, we have 2 times 648 minus 150,000. And their loss goes down a little bit. At 43, we have 3 times 648. So their loss goes down a bit again. Okay. Basically, it's a 5-year policy, right? So we need to do 5 of these. And if the person dies at all during their policy, the insurance company loses money. Okay, so if you get a 5-year policy and you die during that 5-year policy, they're out of luck. They don't get any money. However, after 5 years, they don't pay. And the profit is $3,240. So they're gambling on you not dying during this 5 years and them getting to keep that $3,000. That's how that works. So this is the percentage of people that are going to die. Should that be 0.9? Oh, above, yeah, over 46. Yeah, after 46, that's everybody over 46. So you're talking about 90-year-olds and everything. So pretty darn close to 100% chance of death. Still not 100% though, because you have to include all the 47 and 46 and 47 and 48-year-olds and stuff. Actually, it should be greater than or equal to 46 because it also includes 46. So we have mortality rates shown in the table. If the company sold 10,000 of the same policy, we want to know what would be their expected profit for the 10,000 policies. All right, so we're talking about like their probabilities, correct? So what we have is we have 149,352 loss and a probability of 0.0026 that they will have to pay that money. Does that make sense? Plus, I have $148,704 loss with a probability of 0.0029 that they had to pay it, etc. And we just keep going. All the way through. And when you add all those up, you multiply them and you add them up, you get 866.4024, etc. Okay, per policy, that's each. Well, they sold 10,000 of them. Well, it's not really. Um, we're going to round it to 40 because it's, real money. So they make an $8 million profit on 10,000 policies. And that includes their losses. So yes, do they lose a lot of money on some people? Absolutely, because some people paid in like $600 or $700 and then died, and then they had to pay out a $200,000 policy. But percentage-wise, most people live past the terms of the length of the policy, so those 10,000 people net that insurance company over $8 million over the life of the policy, the 5-year policy. So that's more than, yeah, it's more than $1 million a year per 10,000 policies, and you know that they have more than 10,000 policies at any one given time.